Thank you very much, Julian. It's really great to be here. So what I'm going to speak about is complex climate trade-offs. So when we think about the climate crisis, we think it is so urgent that we should stop talking and start acting. We might think about the Nike logo, just do it. We don't need to talk about issues such as this. But the reality is much more complex. There are a variety of trade-offs where if we pursue the climate agenda, there might be some other types of costs to society, and we need to be mindful of them. And this is absolutely not to downplay the scale, the magnitude, the urgency of the climate crisis, but to, number one, recognize there are other considerations, and number two, if we don't recognize those considerations, then any strategy that we have to address the climate issue might run into problems and resistance. So there's three types of trade-offs that I will focus on in my talk today. So the first is the trade-off between climate and financial returns. Now you might think, well, is there even a trade-off to begin with? If you look at the letters from Larry Fink, the CEO of BlackRock, he claims that climate risk is investment risk. So if you want to maximize your risk-adjusted financial returns, minimize climate risk. He also says our investment conviction is that sustainability and climate-integrated portfolios can provide better risk-adjusted returns to investors. Again, this suggests that there is a win-win and no trade-off. Finally, we believe that sustainable investing is the strongest foundation for client portfolios going forward. And you might think, well, this is what Larry Fink says, but maybe he's talking his own book, so let's go to a more objective source, so the Financial Times. So they produce some really impactful articles entitled The Ethical Investment Boom, claiming the outperformance of ESG strategies is beyond doubt, and many other authoritative newspapers and media outlets have articles with similar claims. But the big concern with all of this is the issue of confirmation bias. So what is confirmation bias? This is the idea that we accept a claim uncritically if it confirms what we'd like to be true. And this particularly applies to ESG investing. We would love to believe that ethical companies perform better, and particularly in the area of climate, we like to think that companies that pollute the planet will meet their comeuppance and later on suffer from lower financial returns. But the problem of confirmation bias is that we will believe things even if it's not backed up by rigorous evidence, and this was the topic of a TED talk I gave at LBS a few years ago called What to Trust in a Post-Truth World, about how critical and how discerning we need to be on issues that we feel very strongly about, like climate. And indeed, there's a book I've written, which is coming out next year with Penguin, called May Contain Lies, about how careful we need to be with simple statements which seem quite appealing. So, how do we apply the idea of confirmation bias to the examples that I've already given? If you go back to the Financial Times article, then a reader wrote in and said, well, actually, the case on ESG investing is far from closed. And he highlighted a number of pieces of evidence suggesting there sometimes is a trade-off. Maybe ethical companies don't perform better. And then if I go to the Larry Fink statements, let me start from the bottom and work up. We believe that sustainable investing is the strongest foundation. But if we are to take some action, it has to be more than just belief. Our investment conviction is that sustainability can provide better returns, but again, we want more than conviction. Is there evidence? And this is why the heartbeat of what we do at London Business School is not just to tell nice stories, but make sure that this is backed up by rigorous academic research. And that's what I'm going to apply to the first statement of Larry Fink: climate risk is investment risk. So is climate risk investment risk? Now, the prevailing consensus is the answer is yes, and this is backed up by some research published in a top finance journal. So the paper finds, and I'm quoting, stocks of firms with higher total carbon dioxide emissions earn higher returns. So more polluting companies earn higher shareholder returns, and their interpretation is our results are consistent with an interpretation that investors are already demanding compensation for their exposure to carbon emission risk. So the idea is that companies that emit a lot of carbon, they are risky. Why? Because there might be a global carbon tax in the future. And so investors are only willing to invest in these risky companies if they are compensated for by a higher return. But let's think about this, and let's think about it critically. Because what happens if we replace carbon dioxide emissions with another ESG factor? So let's replace this with employee satisfaction. So there is evidence showing that stocks of firms with higher employee satisfaction earn higher returns. Now, would the interpretation be the reason for these higher returns is that companies with lots of employee satisfaction are risky? It's just too risky to have happy employees, and therefore we will demand higher returns because we don't want to hold stocks with happy employees. Absolutely not. We would not interpret this as risk. We would interpret this as outperformance. Right, so why is it that companies with happy employees, they do better? It's just these are better companies. They are generating higher financial returns because they are more profitable. And so that might be the interpretation for the carbon emissions result. Companies that emit more carbon have higher profits. Why? Because they can get away with polluting. We don't have sufficient government action on climate change. So there are polluting companies which are able to generate higher profits, and those higher profits lead to higher shareholder returns. So there seems to be a bit of ESG doublethink here, right? If we see a bad thing leads to higher returns, we say, well, that's proof that it's risk. And if it's a good thing, which leads to higher returns, we say, well, that's proof that it is actually good. So the question is, well, how do we disentangle if we have higher returns? Is this a good thing? It's outperformance. Or is this bad thing? Is it compensation for risk? And the standard way to do this is to do what's known as an earnings surprise test. And so this is what I did in one of my earlier papers where I looked at the link between employee satisfaction and long-term shareholder returns. So how do you show that it is outperformance? Well, what I did is I took earnings surprises. So this is every 3 months in the US, a company releases their earnings. And before they do so, companies like Goldman Sachs or my former employer Morgan Stanley, they predict what the earnings are going to be. And I compare how these companies do compared to what analysts were predicting. And I found that companies that treat their employees well deliver higher profits than what the analysts were predicting, and therefore the higher shareholder returns was due to outperformance, not risk. But we'd accepted the early result on carbon emissions without doing that disentanglement. We just accepted the interpretation that we want to be true. So in a more recent paper with other co-authors, what we did is basically the same methodology to try to disentangle the source of the carbon premium. Why is it that these emitting companies are earning higher shareholder returns? And to our dismay, we wish this was not the case. We found it was because they were performing better. They are delivering higher profits. Why? The absence of government action means that they are doing higher, better returns than what analysts were expecting. And just 4 earnings announcements per year can already explain 30 to 50% of the carbon premium. So what are the implications from all of this? Well, number one, it suggests that sadly, climate risk is not investment risk. So the message that we can just leave everything to the market because the market is pricing everything in, the market is already punishing companies that emit, we don't need government action, that is not correct. The market is not getting everything right. Number 2 is that a low carbon portfolio sacrifices risk-adjusted returns. Why? Because emitting companies are performing better. Now, one could say, I don't care, I believe the climate crisis is so severe, I am willing to sacrifice financial returns to decarbonize my portfolio. And that's absolutely fine, but the goal of evidence is just to highlight that there is a trade-off, there is a sacrifice. Many people will still be willing to pay that sacrifice, just like people pay more for organic food, but the goal of evidence is to show that a sacrifice is needed. And finally, there might be potential trade-offs for investors wanting to take climate action between net zero and fiduciary duty. So if fiduciary duty highlights that you need to generate long-term returns to your investors, maybe pension fund beneficiaries, then these are complexities that we need to address. And my colleague Tom Gosling, an executive fellow, has written an article about this in a law journal. Okay, so that's one trade-off that I've highlighted, trade-off between financial returns and climate carbon emissions. Now, the second trade-off is between climate and other environmental and social goals. Let's say we don't care about financial returns, or at least we deprioritize them, but we are concerned about society more generally, not just climate, but other things. There might be trade-offs with those other things. 600 million. What is that? You might think, well, that's the amount of investment per month needed to achieve net zero. No. You might think, well, this is the amount of donations every year to Extinction Rebellion or Just Stop Oil. No. 600 million is the number of people in Africa who don't have access to electricity. So last month, I was at the World Economic Forum in a session on a just transition. And we were talking about in a developed country how we make sure that if we transition towards renewable energy, we don't lose jobs for those employed in fossil fuels. And then a lady from Africa got up and she said, you all talk about a just transition. We don't have anything to transition from. Like, we don't have electricity to begin with, so you responsible investors, you can talk about decarbonising your portfolio, but if you're pursuing this too aggressively, then you're going to stifle economic development for many, many millions of people. So you might think, okay, just stop oil, that is a powerful statement, but for her, it's just stop economic development. So this is one of the things which might be an issue here. Do we need to recognise that there are some countries which don't even have access to electricity? This is, again, not to downplay the severity of the climate crisis, but to recognise there are other issues that maybe us in the West we might not be aware of. And then if we go back to the West, go back to the jobs issue. Because many of us, I have to admit that despite me working in this field, I don't know anybody who works in the coal industry. And the average age of somebody in the coal sector is 55 years old. So if he or she lose their job, then this could be the human equivalent of stranded assets. How are they going to retrain? And this is something with long-term impacts on their family. If their children then are less affluent and then cannot get the same education, that's something with long-term implications, which again, us, perhaps we don't know these people as much, we might not emphasize or recognize when we focus on the very important issue of climate. And let's say we don't care about these social issues. We're somebody whose goal is only to maximize the environmental performance. There are also trade-offs with other environmental factors. So we talk about carbon capture technology, and then I've heard statements like, why do we need carbon capture technology? We have a great carbon capture technology, that is trees. Why don't we just grow loads of trees? Which sounds simple, but sometimes growing trees will consume substantial water. Often in places where people are already thirsty, it will drive people off land. That is not a problem that many of us in the West need to think about, but this is a serious issue. We could say, well, to country X, why don't you grow more trees? Well, there is an impact there on humans. What about emissions reduction? We can also try to have different types of fuels, let's say biofuels, but sugarcane for bioethanol and palm oil for biodiesel. Those are great biofuels, but they can lead to monocultures, and that reduces biodiversity, which is another emerging environmental issue. And the final set of trade-offs is the trade-offs between the portfolio of an investor and wider society. So there are many investors who are very well-intentioned, are taking very seriously the climate crisis, and their goal is to aim for portfolio decarbonisation or net zero portfolios or climate-aligned portfolios. But decarbonising your portfolio does not necessarily mean decarbonising society. So if I own some fossil fuel stocks, if I'm to sell my shares, I can only sell if somebody else buys. So I'm not depriving it of capital. And notice this is quite different from boycotts as a customer. If I choose to boycott a company, then maybe the products stay on the stores. I am depriving it of revenue. But the analogy to investors divesting is not perfect because I can only sell if somebody else buys. I am not starving it of capital immediately. Now, others will say, yeah, we get that, but when you sell and somebody else buys, in order to encourage somebody to buy, you have to sell for a lower price. If you drive down the stock price, then you make it harder for the company to raise capital in the future. And again, that seems a logical argument, but again, if we think about this, if you're an investor and you choose to sell every fossil fuel company in order to reduce their stock price and then make future capital raising harder, well then what are the incentives of a fossil fuel company to reform? They know that even if they are best in class and putting in a credible transition plan which is being implemented, they will still be divested. So this black and white view that we're going to divest from everybody, irrespective of whether you are reforming, just because you're a fossil fuel company, that doesn't provide any incentives. It's just like if a company was to say, my policy is never to hire any ex-offenders. Well, then this means if you're somebody who's been in prison, what are your incentives to reform if you're not going to be able to get a job afterwards? So this is why one of my more recent papers with a couple of other co-authors, what that suggests that actually a tilting strategy or a best-in-class strategy, when I'm willing to hold maybe a fossil fuel company, if it's best in class, if it's taking action to reduce its climate impact, that might be better than blanket exclusion. And notice it doesn't apply just to energy companies. Maybe I could hold something in a hard-to-abate sector, such as cement or concrete, if I'm holding a company which is reducing its usage of clinkers, and that's something which has a huge effect on the environment. Maybe this is something needed. We still need concrete. We still need to build schools and hospitals. Yes, there are emissions associated with this, but can I hold something which is best in class? And the final reason why that's important is that sometimes you might hold a, quote, brown company, a polluting company, but that allows you to engage. Right, so if you have a seat at the table, then you might be able to ensure that the company has a plan and is putting this into practice. Like as a professor, do I want to say, look, I have all the very best students, all my students do very well, or is your job to work with students who might be finding the topic more difficult, and then you work with them in order to improve their knowledge and then end up doing much better than they would have done otherwise? And so if you'd like to learn more on this, there's a great TED talk by a lady called Nili Gilbert, who is the vice chair of the Carbon Trust, which is working on these issues. And it's about how we need to take a very nuanced view on these issues, which are often seen as black and white. And so let me then sum up before we get to the Q&A. So all the three trade-offs that I've highlighted emphasize that there's danger in binary thinking. So binary thinking is saying that divestment is good, holding it is bad. Pursuing climate is good, let's ignore all of the other objectives of society. And also, it's better to always reduce our portfolio carbon footprint, not recognizing that this may mean that somebody else holds the emitting company. And so this is exacerbated by some recent developments. So often people think, well, we need climate action. As a regulator, let's try to come up with some rules and some numbers and some metrics. But with all of these things, we think of the tortoise and the hare, more haste, less speed. We need to take action, but we need to make sure that the action is effective, it doesn't backfire, it doesn't have unintended consequences. So the urgency of the issue does mean we need to act fast, but also we need to act wisely. So we currently have these taxonomies in the EU saying, well, what is good and what is bad, but hopefully I've highlighted that there is no clear distinction between good and bad. Something that generates electricity could well be good, particularly if it's for people who otherwise would not have access to it. Something like producing cement or concrete we still need for construction, but if you're doing this in a way which minimizes your impact on the environment, that could still be a good thing. What are ESG ratings? They're trying to measure the ESG performance of a company. And so this leads to some investors trying to hold highly rated stocks and divest from lowly rated stocks in order to show how committed they are to ESG. But again, if I'm selling the poor performers, number one, I'm not providing them with incentives to reform. And number two, I don't have a seat at the table. I'm not holding these companies. I'm not able to engage with them to improve their ESG performance. And finally, and more specifically to carbon, there are many investors which will report their portfolio carbon footprint. There are even some CEOs of asset managers whose pay is linked to the portfolio carbon footprint of what they're holding. And one of the big trends now in ESG is to pay for ESG. The idea is that if you care about something deeply, let's link pay to it to show that there is bite, to show that you don't just have statements, but those statements have implications for reward. But again, this is problematic because you can simply reduce your portfolio carbon footprint by selling emitting companies and somebody else buys it. It's just like I'm going to clean up the trash in my garden by throwing it over the fence to the neighbor. Right, so I've reduced my trash, but I have not done anything for society, and this is something which may well be a consequence. And also, this only looks at carbon footprint, but not the positive aspects of some activity that generates emissions as a byproduct, such as the production of electricity or the production of cement or concrete. So what might be the solution to all of this? And I might be biased, being somebody who works for an educational institution, but it is literacy and education. But what do I mean by literacy? We hear often financial literacy. We now hear AI literacy. But maybe an important issue is climate literacy. So there is a lot of action and a lot of excitement among young people, and groups like Extinction Rebellion and Just Stop Oil have highlighted the criticality of taking action. But if the message is a one-sided message, we're only highlighting the problems of things like fossil fuels and not the fact that it might be providing electricity, not the fact that it might be currently providing jobs, that in the long term we do want to phase this out, but in the short term there might be some real consequences, then we do have some potentially quite strong policies which are so extreme they may not be implemented. So I've seen some policies suggesting, let's ban all non-essential flights. Well, that would be devastating to a number of countries which rely heavily on tourism for the economy, for jobs, for economic development. And so just to highlight that, yes, we do care about these issues very seriously, but there are also many other considerations around that. I think this would lead to a richer, a more nuanced and ultimately more realistic conversation about climate where we can suggest some ways forward, but those ways forward recognize the trade-offs and therefore they're more likely to be implemented. Okay, thanks very much. I'm going to give to Julian for the...
Thanks, Alex. Do you want to sit down? We've got. Do you want to sit down?
Yeah, sure. Let's do that.
Yeah, let's do it that way. So I've got a bunch of questions, and of course, as Alex was talking, my thoughts were being provoked. I've got a few similar questions. I mean, you're raising the trade-offs. You are absolutely, I think, of course, giving us a much more nuanced view of those trade-offs than perhaps most of us had before. A couple of the questions, I'm going to ask you the specific question in a second, but somebody says, given that these are a series of trade-offs, what's the answer? Somebody else says, how would you like us to move away from this binary thinking? Let me sharpen the question in the following way, which is, we work at business schools, we believe in markets. And as you said yourself, the markets don't get it quite right in this case. So if we have some sort of market failure, we almost always say then the government's job is to step in and to sort of nudge the market in the right direction. So inevitably that leads to questions. One of the specific ones was, isn't carbon pricing the way forward? Tell us about your thoughts on how governments can help to resolve this, if you like, market failure? We'll get to the kind of corporate response in a second.
Yeah, thank you. It's a great question. So what is a market failure essentially? This occurs when there's an externality. So this is when a company has an impact on wider society which ultimately doesn't bounce back and affect the company's profits in the long term. And so then the solution to a market failure is regulation. So one of these could be to completely ban certain activities. So you might ban something like child labour, but something like carbon emissions, where we think there could be benefits but also costs, it's to take the milder solution of taxing so that you are recognising the full social consequences of your actions. So this is why I and a lot of economists and a lot of academics who work on this am a strong advocate for a carbon tax so that companies will face up to the consequences of their actions. Because actually the market is not failing in pricing things. The market correctly prices carbon emissions under the current regime, which is not to punish emitting companies because there's no consequences. So the market gets things right given the regime, but I'm suggesting we need a different regime.
Got it. So that's, and of course we know there were challenges, technical challenges in implementing these things, but I do completely buy into that direction of travel. Moving to the corporate side then, and you touched on this, and I know you've written about it elsewhere. What's your advice, if you like, to these chief executives who are looking at these trade-offs and they are making this inevitable choice to some degree in the short term between, of course, doing good in the world versus making profits. We know that that's a stylized choice. We know that the truth is, of course, more nuanced. How do you advise companies to resolve that trade-off?
I think it's a great question, because some people might say, oh yes, the government is who should deal with it, but if the government isn't dealing with it, then the companies need to step in. And I think if there are trade-offs and you're pursuing something because you care about the climate and there's a financial cost to that, I think this is fine. So I think there are many investors who will support companies who make some return sacrifices to address the greater good. We saw this in the pandemic, where many companies were giving products for free. Is this because they're forecasting in the future our reputation will be improved by this and it's going to come back to help us? Or is this because we think this is the right thing to do? And there are many shareholders who supported companies doing that, or companies which may be furloughing their workers and continuing to pay them rather than just laying them off immediately. So I think when you have this message and you say, well, it's a completely win-win, we're going to do something and there's never going to be a financial cost, then shareholders then get upset if you deliver substandard results. But if you're upfront as to why you're doing this, I think this gives a much better message and you're more likely to be supported. Why do shareholders invest in the company? It's not just to get a higher return in the future, but to get a higher standard of living in the future. Right? When I retire in, 40 years' time, I don't just care about my income, but whether the planet is 2 degrees warmer or whether we have a cohesive society. So there are many investors, and the pension funds survey their beneficiaries, and they realize that they don't just care about financial returns, they are willing to pay the price of a trade-off, but just be upfront that there is a price to be paid.
And many in the audience remember Danone, the French company. Emmanuel Fabre was the chief executive, who was very, very thoughtful about the environment. I think they made them into a benefit corporation. He lost his job, at least in part because the board felt he wasn't delivering enough financial returns. Any reflections on that? I mean, did he just push, shall we say, too far? Because a lot of what he did was things that I think you and I would probably agree were good things to be done.
Yeah, so this is interesting. So if you read sort of how this is often portrayed, they say this was a visionary CEO who wanted to do the right thing, but it was the short-termism of the stock market which prevented him from doing so. But the reality was that he was at Danone for 6.5 years. So this was a long time period, and the company's stock price was flat, whereas the CAC 40, which is the peer group, that had gone up by 50%. Unilever, other competitors have gone up by 50%. And why is this? Well, Yanis has also done some work on this. It's because of some poor strategies, some poor strategic decisions, some poor acquisitions, some poor corporate governance. And so what this suggests is that, yes, you can do good things for the environment and for society, but you are also a business. And so the challenge of a CEO, yes, you do need to deliver on ESG goals, but you are also a business and you also need to deliver in the standard stuff as well.
Indeed. A final question. You and I, Yanis, we're all teaching our students. We're hopefully doing a decent job. Are we teaching outdated theories? Because there's a hypothesis out there that all of our theory is rooted in this sort of traditional shareholder-based view of the world, and that's somehow actually teaching our students the wrong stuff?
Another great question, and I have incentive to claim that we are. Why? So the textbook that I learned when I was an undergrad at Oxford and when we started at Morgan Stanley was Principles of Corporate Finance by Breland Myers. I am now a co-author of that book for the 14th edition, which came out a few years ago. I would love to claim I completely rewrote the book, scrapped 30 years of outdated work, and I'm changing it. But that's not the case, because actually, in many cases, traditional business theory is about the long term. Now, it may well be that the long term 100 years ago was an oil company engaging in exploration and production, and that is not what we would call long-term right now, but that aspect of investment, that long-term investment, was something supported by business principles. What is shareholder value? The very first class in finance shows you that shareholder value is the present value of all future dividends right until the end of time. So somewhat bizarrely, maybe some of the concerns are not enough focus on shareholder value. And this might seem heretical, but the problem is companies are focusing too much on short-term profit. Short-term profit is not long-term shareholder value. Long-term shareholder value would say to a car company, invest in electric cars. This is something which will cost you in the short term, but in the long term it will benefit you. Beyond climate, long-term shareholder value will say invest in a diverse and inclusive workforce. It will cost you in the short term, but it will benefit you in the long term. And I think the message that we need to completely scrap the rule book and go to something new, that can be a damaging message, because then some companies think, we've been successful for so long without this, why do I suddenly need to change? Or do I have to go with something unfamiliar and untried and untested? But given that what makes business successful and has done so for centuries is a focus on long-term value creation, I think that message is something which should still be getting across.
Perfect. We are going to close there. Thank you very much, Alex, for a fascinating talk.
Thank you.